And as you know, I've been overweight Ethereum for a long time now, and it's paid off very well. And I expect it to have another leg higher. So I'm more interested in Ethereum than Bitcoin. That's not from a philosophical standpoint. I think Bitcoin's bad. We're here to make money, and we're here to try and capitalize on the growth of digital assets and Web3. And Ethereum looks like it's a better bet. I think there's some tokens, many tokens will outperform Ethereum. I kind of think Solana might. I don't know. I might be right, might be wrong, but Ethereum, I'm very comfortable that it should do extremely well and should outperform, particularly with what's going on with the merge. Now, if I look at the price action of that spread, the ETH Bitcoin cross, it put in a weekly demark low. That's a great signal and exploded higher from that. I think it might retest the top of that channel, pull back as ETH corrects a little bit, and then explode higher again. So that's the kind of price action. It's confirmed by my demark indicators, which I really like as well. And the chart pattern is particularly good. When I look at ETH on its own, it put in a weekly 9 and 13 low. That's a really strong signal of trend reversal, not just a correction, trend reversal, which why I started accumulating much more Ethereum over the last month or so, because this signal was in place. This signal in place was my go, because it was exactly at the right point on the exponential moving average, the logarithmic curve, the on-chain activity, the RSI. Now I've got so many indicators suggesting this is the point. So why Ethereum now, apart from the charts, is the merge. The merge is probably the single most important thing that I can think of that I've seen in crypto since the invention of stablecoins and the launch of ETH itself. Now, that's quite a big statement, and there are risks that it doesn't work fully. I get that. I'm prepared to take the risk because I think it will. You may not be prepared to take the risk, and that's fine too. So let's talk about the merge. So first we need to go back in time a little bit. We go back in time to the burn. So this is the EIP 1559, and what that did was change the dynamics of ETH that burnt using network activity that burnt ETH. Now, it reduced the supply of ETH by about 65%. And in a strong demand environment, supply reductions are important. They're not in most other times, but really when demand meets reduced supply, then things get interesting. So ETH massively outperformed Bitcoin because of this activity, because the ETH network is being used for DeFi, NFTs, all sorts of stuff. And with reduced supply, the price went up faster. That kind of makes total sense to me. But the merge is something much bigger overall. The merge is where Ethereum goes to proof of stake as opposed to proof of work. So now you're not having computers crunching the maths and being rewarded as miners for doing the work. What you're doing is you're pledging your Ethereum for a year to secure the network. And that's called staking. And staking participates by you getting a yield for doing that, which is staking your coins, i.e. you can't use them, and you get a return. So I'll come on to that in a sec. But what's really interesting here is this is a supply reduction of really monumental proportions that's about to happen. Now, I'm more of a demand side person than a supply side person, but when demand and supply are both in shock, okay, then we got something interesting. So what's the supply side? Well, miners. There are no miners anymore. So therefore, all of the activity of miners of selling the tokens that they've earned, they probably sell about 80% of the tokens that they get just to fund their own activities. That's about $1 billion or $2 billion a month that's out of the market. So that's a small supply shock. There's no ongoing pressure every day from miners who've been rewarded with Ethereum. So that goes. Okay. Then the staking activity, there's currently about 9% of all Ethereum staked. By most guesses, that number should rise to about 30% because initially we should see some outsized yields, maybe up to as high as 20%. Maybe it's 15%. Who the hell knows? But either way, it's going to attract a lot of capital into staking. And so that becomes very interesting itself, because if it gets up to 30% of all ETH staked, that's 30% that is dormant. That's 30% cannot be used for DeFi, CeFi, rehypothecation, shorting, liquidity provision, nothing. It's out of the system. Okay, that is a massive supply shock. Then, on top of it, ETH staking gets its yields from network activity. So as the network is active, it generates the yield. Add that to the burning for the network activity as well, and what you get is actually something that looks like it's going to be deflationary, i.e. there's going to be less ETH every day than there was the previous day. So that itself is really interesting. So as opposed to be a daily sell pressure of excess ETH in the market, it becomes a daily buy pressure. Now, this might sound familiar to you because this is very similar to buybacks and dividends. So buybacks and dividends are very predominant in the US. It's one of the key reasons why the US markets have outperformed other markets. There are dividends, not mainly in tech stocks, but other stocks, there's a lot of dividends. But buybacks are very big because of the tax breaks. So if you keep reducing the supply of equities by buying them back, you generate demand and reduce supply. So then in normal economic times, you find that the markets, because there's less equities around, because the market cap, the divisor for the index, there's less around. So therefore the index goes up more. That's a natural function. When you add stuff like ongoing demand from 401ks and passive flows, it creates this outperformance that the US has enjoyed for so long, outside of the fact that, technology has been the home in the US and it's had better equities and stuff like that. But there's this supply and demand dynamic of buybacks plus dividends. And you can see that the impact on price from this chart now, it shows that they're very correlated because it is just a nice dynamic that helps price performance over time. So we've got that. So this is the supply starting to move into demand, but there is a demand shock coming. One is the macro cycle. The macro cycle is turning. So therefore demand is going to come back as liquidity comes back. Secondly, ESG. Now, whether you agree with ESG narratives or not, it's real and there are mandates built on it, particularly in Europe, but increasingly in the US. Bitcoin is deemed by people to be less green. We know that narrative is a false narrative, but that is what institutions kind of believe, and they struggle to get it past their boards and their investment committees because of it. But Ethereum will be much greener. In fact, it's 99% less energy use than Bitcoin once it moves to proof of stake. So that removes that barrier, and that's a big stumbling block for institutional adoption. But there's something more important, something that most people haven't thought out, which is that Ethereum is going to have a yield of 4 to 6%. That's the best guesses. So now we've got the internet bond. And I know people have used that terminology before, but they haven't really joined the dots as what that means. Ethereum being the largest yielding asset in the space, it has in ETH terms, a risk-free yield because it's generated by a smart contract. So it pays out yield in the smart contract. Now, the risk you're taking is currency risk, ETH. And again, people need to understand what these terms mean because there's a lot of bullshit online. So what you've got is pretty much a guaranteed yield from ETH. Obviously, there are things that go wrong. US bonds are deemed risk-free, but they're not. Nothing is in the world. But you know what I mean? This is a benchmark yield for Web3 from the largest asset in Web3 because Bitcoin doesn't have a yield in the same way and it's not really used in Web3. So you want to allocate to this space. You are going to allocate to the ESG compliant yielding asset. That is without question. Also, it's easy to say because it's not to do with money, replacing of money. It's technology. This becomes like a technology stock with buybacks and dividends, which is bloody rare. And it's the fastest growing technology in the world.